Following the imposition of tighter economic sanctions by the United States and the European Union over the weekend, Russia's central bank more than doubled its primary interest rate to 20% on Monday, sending the ruble to a new low. Russian President Vladimir Putin's decision to unleash a full-scale invasion of Ukraine is inflicting havoc on the country's economy. Worse, more business titans are leaving the country, and citizens hoard cash. Is there any way this battle could get any worse? Make sure to finish this video to get hold of the latest happening in the financial market brought by the Russian-Ukraine crisis. The Russian market is getting worse than ever. US ETFs showing signs of extreme financial damage. Investors in exchange-traded funds who did not sell their Russia-focused funds before Moscow's tanks entered Ukraine pay the price on Thursday, February 24, 2022, as prices plunged, trading spreads increased, and short sellers cashed in. The 24.7% drop in Russia's benchmark Molex index, which has already lost 45.7% year-to-date, has resulted in catastrophic losses for country-related ETFs. In U.S. trading on Thursday, the VanEck Victor's Russia ETF plummeted 25.5%, extending its year-to-date loss to 47.1%. The iShares MSCI Russia Capped ETF plunged 19.5%, bringing its year-to-date loss to 44.3%. While the Direction Daily Russia Bull 2X ETF dropped 46.9%, bringing its year-to-date loss to 74.7%. When bid-offer spreads expanded amid the chaos, long and erroneous investors who attempted to exit their positions on Thursday may have incurred even higher losses. The London Stock Exchange issued a rare notice, allowing market makers to offer spreads of up to 10%, which is twice the amount allowed for ETFs during the COVID-induced market panic in March 2020. Market-making spread exemptions were also granted by Borsa Italiana, a Euronext affiliate. Market makers may be cautious about taking on additional risk during moments of greater volatility, so the broader spreads are meant to entice them to keep trading Russia-focused ETFs. Borrowing costs have also increased for individuals wanting to hedge their risk by shorting Russian ETFs, showing that demand for the ETFs outnumbers supply. According to data from S3 Partners, a specialist data provider, borrowing fees for RSX, Russia's largest and most liquid equity exchange-traded fund with $1.03 billion in assets, increased to 5.3% on Wednesday, even before the invasion began, from 2.8% on Monday and 0.3% in December. The rate for borrowing less liquid RUSL was 9.8%, up from 6.1% late in December, according to S3, while the fee for borrowing ERAs was 1.3%. All three are much higher than the 0.9% average borrow rate for US-listed ETFs. According to S3, short interest in the RSX was at 27% of the free float, whereas it was only 3.7% in the RUSL. ERAS, Russia's second-largest ETF with $408 million in assets, was up 14.4%. While these statistics aren't outrageous, 22.3% of the average US ETF shares are currently on loan. Individuals who shorted the ETFs this year will be sitting on significant paper gains, even before the market's recent drop. With less than 10 months till the end of 2022, RSX shorts are up to $86 million in 2022 mark-to-market profits, a 23% return on an average short position of $369 million, according to Ihor Dusanuski, Managing Director of Predictive Analytics at S3. He projected that ERA shorts had made $17.9 million in year-to-date mark-to-market profits, while RUSL shorts had made $0.93 million more for a total return of 43.6%. With Russia's stock prices decreasing, we should see more short selling in Russian ETFs. Dusanusky added, noting that shorting Russian domestic stocks is difficult due to their more liquid stock loan market and lower short-term lending costs. The RSX and ERAS ETFs likely see the most activity. Hey, take a breather there for a moment. If you have not yet subscribed to our channel, please click the subscribe button to ensure that you don't miss any of our videos. JP Morgan Asset Management has also suspended its Russia equity fund, citing normal market trading conditions have been significantly impaired due to the escalating conflict between Russia and Ukraine. At the same time, ABRDN announced this morning that it will refrain from investing in Russia or Belarus for the foreseeable future due to ESG concerns, adding that it has already taken action to reduce its exposure to these regions. ABRDN is a United Kingdom-based global investment company headquartered in Edinburgh, Scotland. The concern is how these CEOs would unwind their investments without losing a lot of money. In response to the sanctions, Russia's central bank barred all coupon and dividend payments to foreigners and all foreign currency transfers to foreigners in connection with credit agreements, causing even more concern. JP Morgan AM earlier said that the disposition and valuation of the firm's interest are impracticable regarding the liquidation of its Russia fund. On the 24th of February, MSCI issued a freeze on all Russian assets, followed by a Monday call for feedback on the Russian stock market's accessibility and investability for foreign institutional investors. The agency has cautioned that MSCI Russia indexes may be reclassified from emerging markets to standalone markets, which could significantly impact portfolio inflows. In addition, the trade can report that in response to Russia's invasion, ESG ratings portal Seva.I downgraded the overall rating of all firms listed on the Moscow Stock Exchange to 0. Emanuela Bartolome, CEO of All Street, remarked that she bitterly opposed Putin's decision to attack Ukraine, and she felt a personal obligation to take real action. She further stated that every company must do everything in its power to destabilize Putin's tyranny, and All Street's action today reflects that. While active trading on the Russian stock market has ended, massive losses among Russian funds based in the United States highlight the severity of the current situation. The VanEck Russia ETF, which has over $1 billion in assets, and the iShares MSCI Russia ETF, which has over $350 million in assets, have reportedly lost nearly 25% of their value. Fear has spread to emerging markets, with practically all asset classes seeing significant losses this week. The Emerging Europe Equity Fund of JP Morgan Asset Management has already discontinued operations. However, the Lion Trust Emerging Markets Fund has not. McLaughlin told the trade that they have no plans to terminate the portfolio, but there are usually knock-on implications into other markets when the Russian market is shut down. As a result, bid-offer spreads have widened and book depth has shrunk, especially in riskier assets. The trading environment has unavoidably become more expensive on a larger scale, while equities volumes and spreads have increased. The volume available for trading on the principal touch has reduced, McLaughlin explained. The risk to global markets appear to be primarily to the downside. Investors are playing it safe as Russia, growing inflation, rising interest rates, and the rest of COVID form a perfect storm. There have been no rash decisions, no cash withdrawals in unexpected activities. Everyone is being really cautious right now because things might drastically shift for the worse or the better, McLaughlin added. If an agreement is reached, potential peace talks might quickly change the course of events. We are keeping a careful eye on the situation as it changes hour by hour. Subscribe and hit that notification bell to watch more from the latest worldwide. Tell us what you think about this video by leaving a comment below. We are Dinero Association, your partner in building wealth.